So unit 4 basically is about the financial statements. The financial statements really define the accounting process, which talks about the assets being equated to our capital plus the liabilities. Now, when we're dealing with our financial statements, we're basically looking at three key books. Number one, the first book that we'll be interested in is a balance sheet. The balance sheet is also known as the financial position. The second book will be that which looks at the financial performance of the business, which is the income statement, and we'll finally look at the cash flow statements. Now, unit 4 basically is a little bit wide and happens to be the toughest unit because of the adjustments. So you need to take me very clearly. Now, as we look at the preparation of the income statement and the financial position, you understand that these are dependent on two key books that we need to really take note of. Number one, the ledger accounts, and the other one is a trial balance. The ledger account and the trial balance. So using the duality concept of the ledger account, we understood the fact that the debit side is the left side and the credit side is the right side. So to identify the accounts that are increased by debiting, we use the term PEARLS, P-E-A-R-L-S. So all accounts that increase purchases need to be debited, and all accounts that increase the revenues or sales or capital need to be credited. Expenses, to increase them, you debit them. The liabilities, to increase them, you credit them. The assets, to increase them, we debit them, and the sales, we credit them. So with this recap from our previous two chapters, we'll now proceed to also understanding that the accounts that will spread into these two key financial statements or reports are from the ledger account, which we talked about as being number one, the asset account. Asset accounts really look at both the current and non-current, as well as the intangible assets. So when you're dealing with the current assets, we're basically looking at these assets which are easily convertible into what? Into cash, such as cash, debtors. We're talking about the cash at bank, our prepayments, our debtors. Debtors are also called sundry receivables. Motor vehicles is under the non-current assets, which were originally called the fixed assets. Goodwill, which is an intangible asset. Then the other accounts that come from the ledger account were the liability accounts, which stipulate what the firm owes. These will be subdivided into what are called current liabilities and non-current liabilities. The current liabilities are simply our debts that are payable within a short period of a year and below, whereas the non-current liabilities are looking at the debt which are payable after a year, which may include long-term loans and debentures and bonds. The equity account and capital accounts are simply accounts which look at the amount that the business put in the business by the owners through the share capital or the retained earnings. The expense accounts really look at what we call as revenue, expenditure, or operating expenses like telephone, salaries, and also look at the revenue or sales account, which may come from both the sales, which are credit, or cash sales. So the preparation of the financial statements comes or emanates from what is called a trial balance. A trial balance is simply a list of balances. So these will need to be digested into these key accounts. The trading account, the profit and loss account, these collectively make what we call our income statement or the trading profit and loss account. And finally, our statement of financial position or the balance sheet. Now, the balance sheet is the one that edifies our key accounting equation, which says assets is equal to what? Liabilities plus capital plus reserves and profits for the year. So our assets are equated to liabilities plus capital. So from the trial balance, which are a list of balances of which emanate from these types of accounts, you discover that the expenses the sales returns, purchases returns, the closing stock specifically, these ones go into what we call the trading account. The main job of the trading account is to produce what we call the gross profit. So it is made up of these elements. And the elements that make the profit and loss account are simply expenses. When we net the expenses from our gross profit, what we get is called the net profit. So the function of the profit and loss account is basically to produce what we call our net profit. And finally, our trial balance with the assets, liabilities, capital, and reserves will be pushed into what is called our balance sheet, which defies this accounting equation. So these are the key elements of the financial statement. The income statement comprises of two books, the trading account and the profit and loss account. And the balance sheet, or the statement of the financial position, basically looks at the elements which are assets, capital, liabilities, and reserves. And the statement of cash flows, which we'll look at later on. Now, the income statement, or the comprehensive income statement. This is primarily there to determine whether the firm or the organization is actually making a profit or a loss. That is the main job of this comprehensive income statement. So the format is as follows. We have our sales, we list sales returns, and what we're going to get is our total sales turnover. Then from the sales, when we list our cost of sales, we're going to get our gross profit. From the gross profit, when we subtract all the operating expenses, what we're going to get is the net profit for the year. So this is simply a snippet of how the income statement looks like. Of course, it can be broadened when we look at our detailed copy of how the income statement may look at. Then when we go to the balance sheet, the main purpose is to give the picture of the financial position of the business as at a particular date. So this balance sheet actually reveals whether the business is solvent or insolvent, because it presents a firm's resources in terms of the assets, liabilities, and the equity from the shareholders. So the format of the balance sheet is we have the non-current assets, which are also called what? Our fixed assets. We add our current assets, which are called which are our current assets. We add them. The total is what we call our total assets. Then we equate them to the current liabilities, which will be added to the non-current liabilities. Then will be added to capital. Then they will give us our total equity. So this now fulfills our accounting equation. This is asset should be equal to our liabilities plus the capital. So this balance sheet must always what? Balance. That's why it's called a balance sheet. So the format of the balance sheet. What comprises of the non-current assets? So non-current assets are actually called the fixed assets. They comprise of assets like the land. We subtract the accumulated depreciation, the buildings. We subtract the accumulated depreciation, the plant and equipment. We subtract the accumulated depreciation, fittings and fixtures, less depreciation. Of course, land usually appreciates, so it's so rare that we are going to less depreciation in most cases. But this is just for you to understand. Motor vehicles also depreciate. So what we get is the total of the fixed assets, which are called the non-current assets. Then when we go to the inventory, you will discover that inventory is always arranged in the order of liquidity, starting from cash at hand, cash at bank, the prepayment, the debtors, and the stock. The stock is also called inventory. The account receivable are our debtors, and prepayments are simply the money that we pay in advance. Then it goes on down, which should be equated to our capital and liabilities. So we have what? Capital, reserves, and net profit, which net profit comes from the income statement. So when you add these, we get our total capital at the end. Then we add both the current and the non-current liabilities. The current and the non-current liabilities. So the current, non-current liabilities are simply the long-term what? The long-term liabilities, which include the loans, the capital grants, the bonds, and the debentures. And when we add the current liabilities, these are short-term debts like account payable, a bank overdraft, and an accrual. An accrual is simply money that we are still owing. So when we total these ones up, the balance sheet will now balance up. Now, the non-current assets or the fixed assets, these are assets which are meant for use. They comprise what we call capital expenditure. They're meant for use in a business. These are to be used to generate sales or profit. Examples include land, buildings, fixtures, machinery, and motor vehicles. And the current assets actually are listed in order of liquidity, and they're easily converted into cash, like inventory, amounts receivable, cash at bank, and cash at hand. And the liabilities are in two categories. We have the current and the long-term liabilities, which I've already explained. So the preparation from the trial balance, you'll be asked to prepare our comprehensive statement of the comprehensive income statement, statement of the financial position, which is the balance sheet. So this is a trial balance. It has a capital, which is always credited. Motor vehicle, it has a debit balance because it's an asset. Bank, cash, purchases. So these are assets. Purchases always have a debit balance, and our sales always have a credit balance. Expenses, debit balance. Rentals are all expenses, debit balance. Trade Kings. Why is Trade Kings on the credit side? Can somebody quickly explain? Trade Kings can only be on the credit side because they should be our what? Our creditor. If the amount was here on the debit side, we would simply have said that Trade Kings is our what? Our debtor. All right. So we also go to Toyota Zambia. This is a creditor. Closing stock, the amount of stock that we have. So this is an asset. Prepayment, these are assets. Accumulated depreciation, they reduce our what? Our assets. So we credit whenever reducing assets. So this is basically what Unit 4 was basically all about. So when we go to our quiz quickly, questions pertaining to this were as follows. Number 1, we asked to say the profit of the year reported in the statement of the comprehensive income is to be taken to the statement of the financial position and shown to be part of what? The profit has to be taken to the balance sheet to be part of what? Equity. So net profit, when you're taking it from our trading account, when it comes to balance sheet, it's part of equity. Next question is, the nature of the financial statements is that these are a dash representation of the financial position and the financial performance of an entity. They are a structured entity, as was illustrated here. They are a structured representation of what? The financial position of the company. All right. Then when we go to our next question was one of the objectives of the cash flow statement is as follows. The cash flow statement is mainly to assist in the assessment of the entities, liquidity, solvency, and financial adaptability. So this is the main job of the cash flow statement. It is mainly to provide, assist in the assessment of the entity, liquidity, the solvency, and financial adaptability. Then the formula for calculating the cost of sales. What is the formula for calculating the cost of sales? So firstly, we said that the income statement, we start with what? Our sales here. Sales are here. Then we're going to less the sales returns. So sales returns, when we less them, the total is going to be called our what? Our sales turnover. I mentioned this. Or total revenue, sales turnover. Then we now calculate the cost of sales. Cost of sales will be as follows. We'll start with the opening stock, opening inventory, which comes here. Then we are going to add purchases. And the purchases, we'll put them there. Then in case there are any purchases that were returned, we'll less them. Less purchases returns, we'll less there. Subtract them there. Okay. Then after this, we're going to less what? The closing stock. When we less our closing stock, these collectively will be called the cost of what? Sales. Cost of sales. So cost of sales, the total will give us what we call the gross profit, or GP. So the question is, how do we calculate the cost of sales? So cost of sales is opening stock, plus the purchases minus the purchases returns, then minus the closing stock. So our answer is B. That is how we calculate our cost of sales. Then we went to the next question, which was asking us that the typical period end adjustments usually exclude what? The end of the period adjustment for our period we usually include the closing stock. There is usually some doubtful debt. There is usually prepayment and accruals, then income that way, and end. These ones are usually there. These are adjustments that are added at the end, but cash transactions are already entered. So the answer was E. We have adjustments at the end of each period, which include the provision for doubtful debts, the closing stock, the prepayment, the accruals, the unended income, or the unreceipted documents. But the cash transactions are never in the adjustment. So that is the answer. Then we are told that the trial balance has the following transactions. It shows that bank account has a credit balance of what? 20,000. All right. So the bank has a credit balance of 20,000. Whenever a bank has a credit balance, it means that is an overdraft. Then cash has a debit balance of 2,000. Then trade creditors have a credit, all those creditors have a credit balance of 15,000. Then we have accruals with a credit balance of 1,500. Accruals expenses. So possibly debited. Then accumulated depreciation with a balance of 35,000, and the long-term loans with a credit of 150. How much will be disclosed as the current liabilities in the financial statement? So which ones make up the current liabilities for the balance sheet? So we talked about the current liabilities. Current liabilities will include what? Is cash a current liability? Is cash a current liability? No. This one is an asset. What else? our bank balance was on the credit side. So bank is supposed to be on the debit side. So it was on the credit side, so it was an overdraft. So we'll qualify this. 20,000 is part of what? We're only looking at the liabilities and Congolese. So 20,000 is a Congole. Then we're also told that trade creditors had a credit balance of 15,000. So we add that because these ones are actual creditors. Then accruals 1,500. Add that 1,500. Then accumulated depreciation. This one is not a what? A liability, just reduces the assets. Okay. Then the long-term loans. These ones can't be part of the current liabilities because they are long-term. Okay, so we'll just add these three. So this is 500 here, and this is 6, and this is 3. So we get 36,500. So these ones are called what? Our current liabilities. They're called our current liabilities. This is how we get this figure. So you need to identify which ones make up the current liabilities. So we looked at this statement with the attributes of the current liabilities. We said current liabilities must have what? Account payables, a bank overdraft, if they are accruals. So these are the ones that we have had in there. Are we following?
Yes.
All right. Then we go to the cash flow. In the cash flow statement, we said cash flows usually include receipts from the sales of investments and subsidiary undertaking. It also shows separately any balances of cash overdraft transferred as per sale. So this is what is included in the what? In the cash flow statement. Then we also asked that the statement of changes in equity will usually show the changes in accumulated reserves and capital received, paid, and amounts of dividends paid. So this is what is actually found in our statement of changes in equity. It usually pertains to what? Accumulated reserve, share capital, received or paid. It has to do with the reserves. So we go to the closing stock. Now the closing stock are reflected in the statement of the comprehensive statement as a debit in the trading account. Is this true? As the closing stock is reflected in the statement as a debit part of the trading account. Closing stock, is it true? Yes, supposed to be true here. All right, because it is a what? It is an asset. Assets have a debit balance. Then the trial balance of the company shows the following. Number one, we have 300 of motor vehicles at cost. We have fixtures and fittings amounting to 10,000. We have motor vehicle accumulated depreciation, which is 50,000, and the amount has been prepared and sent to the statement. So we're being asked what amount has to be reported in the balance sheet in respect to our motor vehicles. Now the motor vehicle was costing 300,000. So that is 300, the cost of it. Now we've been told that this motor vehicle has had a depreciation, accumulated depreciation of 50,000. So we subtract the 50,000 there, accumulated depreciation, so that we get the net book value. So this becomes 250,000. So 250,000 becomes what? The net book value of our motor vehicles. So the answer will be 250. So this is how this quiz was supposed to be tackled and answered. Any questions? Any questions?